Tariffs. The very word can send shivers down Wall Street and cheers through Rust Belt factory towns. In American history, few economic tools have caused such drama, from Depression-era trade wars to modern-day geopolitical showdowns. Today we're counting down the top 10 financial implications of U.S. tariffs in a critically toned storytelling journey for investors. Number 10, the Smoot-Hawley Saga, a cautionary tale in trade wars. In June 1930, as the Great Depression loomed, President Herbert Hoover signed the infamous Smoot-Hawley Tariff Act against the pleading of over 1,000 economists and business leaders. Even auto magnate Henry Ford visited the White House to urge a veto, calling Smoot-Hawley an economic stupidity. Hoover signed anyway, hiking tariffs on over 20,000 imports. The world retaliated in kind, sparking the mother of all trade wars. The financial fallout was swift and severe. U.S. imports plunged by 66% and exports by 61% within a few years, as global trade collapsed by roughly 2/3. American farmers were gutted as foreign markets closed, and the stock market, already reeling from the 1929 crash, sank further. Unemployment, 8% when Smoot-Hawley passed, skyrocketed to 25% by 1933. The tariffs worsened the depression by shrinking trade, hurting export industries and fueling bankruptcies. Investors in the 1930s watched in horror as protectionism turned a recession into a nightmare. Smoot-Hawley stands as a stark warning. Tariff wars can spiral out of control, crushing economic growth and portfolios alike, a lesson modern policymakers and investors haven't forgotten. Fast forward to today, and tariffs remain a hidden tax on consumers. When the United States slaps duties on imported goods, importers usually raise prices to cover the cost, meaning American families pay more at the checkout counter. A vivid case came in 2018 when tariffs on imported washing machines took effect. Within months, the average price of washing machines jumped about 12%, and even dryers, which weren't tariffed, climbed 12% in price, as manufacturers took advantage of reduced competition. Researchers found U.S. consumers paid $1.5 billion more annually for laundry appliances, which translated to an astonishing $820,000 in cost per job created in the domestic washer industry. In short, tariffs on washers became a very expensive way for Americans to subsidize a handful of manufacturing jobs. American consumers have felt similar pain at grocery stores and malls. During the 2018 to 2019 U.S.-China trade war, thousands of everyday items from electronics to apparel saw price upticks. One analysis by the Congressional Budget Office estimated that tariff-driven price increases effectively cost the average U.S. household around $1,300 per year in lost real income. Another study in 2019 noted that U.S. buyers, not Chinese exporters, bore essentially the full cost of tariffs, as Chinese firms largely did not cut prices to offset U.S. duties. For consumers, tariffs act like a sales tax on imported goods, often invisible at first, but very real when added to the price of cars, phones, or groceries. And it's not just abstract statistics. Consider cars. In the 1980s, to protect Detroit automakers from a surge of Japanese imports, President Reagan negotiated import quotas, a form of tariff by another name. The result? Car prices shot up by about $1,000 on average, padding Detroit's profits but pinching Americans' wallets. By limiting cheaper Japanese cars, the policy gave U.S. automakers room to raise prices, effectively a hidden cost to consumers. Higher prices also dampened demand. U.S. auto production was intentionally cut back, and an estimated 60,000 American auto jobs were lost between 1982 and 1984 despite the protection. For investors, these consumer impacts matter. Pricier goods can mean lower disposable income, shifting spending patterns and even higher inflation readings, which in turn influence interest rates and retail sector earnings. In short, tariffs can quietly siphon money out of consumers' pockets with ripple effects across the economy. While consumers pay more at the store, companies pay more for parts and materials, squeezing corporate profit margins. Tariffs raise input costs for manufacturers and retailers that rely on imported components, and it's not always easy to pass all those costs on to customers. This was glaringly evident during the Trump-era tariffs on steel and aluminum in 2018. Automakers, for example, suddenly faced pricier metal for car production. Ford Motor Company famously revealed that the steel and aluminum tariffs had taken about $1 billion in profit from the company by raising its costs. The irony, as Ford's CEO noted, was that Ford was sourcing most of its steel domestically, but tariffs let US steel producers hike prices, so Ford paid more even on US-made steel. Rival automaker Honda reported hundreds of millions in extra annual costs due to steel tariffs, despite buying 90% domestically. In the end, tariffs boosted commodity costs for manufacturers, which warned that new car prices would rise as a result. For stock investors, these higher input costs meant weaker profit margins and earnings misses in affected industries. And indeed, auto stocks lagged during that period. High-tech companies felt the pinch too. In the US-China trade war, Apple and other electronics makers reliant on Chinese supply chains found themselves stuck with tariffs on key components and products. Apple dodged direct tariffs on iPhones initially, but parts like power adapters and accessories weren't so lucky. CEO Tim Cook embarked on an intense lobbying campaign to exclude Apple products, wary that tariffs would make devices like the iPhone more expensive and less competitive. Even so, by mid-2019, Apple had reportedly tweaked its supply chain to move some production of AirPods, Apple Watches and other gadgets out of China to countries like Vietnam to mitigate future tariff risk. Other firms, from toy companies to solar panel installers, similarly warned that tariff-added costs would force layoffs or price hikes. For investors, squeezed corporate margins show up in stock performance. During tariff announcements, shares of companies with heavy import exposure often tumbled. For example, when new China tariffs were floated, retail giants like Walmart and Dollar Tree, big importers of cheap goods, saw their stock prices wobble on fears of margin erosion. Analysts began peppering CEOs on earnings calls. How are you managing tariff costs? Are you raising prices? The uncertainty alone became a drag on valuations. In essence, tariffs act like a rising tide lifting costs for corporate America, a tide that can swamp profits if companies fail to adapt. Savvy investors learned to scrutinize supply chain details in 10Ks and to favor firms with more domestic sourcing or pricing power to weather the tariff storm. Supply chain shake-up, adapting, moving, and workarounds. Tariffs don't just add costs, they force companies to rethink their entire supply chains. When tariffs hit, businesses get creative to soften the blow. Some rush to find new suppliers in countries not subject to tariffs. Others tweak their products or even shift production overseas to dodge the import taxes. This game of supply chain whack-a-mole was clearly seen during recent US tariff moves. One dramatic example: washing machine manufacturers. Before 2018, whenever the US targeted a specific country, say a tariff on Korean-made washers, global companies like Samsung or LG would simply move production to another country, for example, from Korea to Vietnam or Thailand, to escape the tariff, often even lowering costs through efficiency gains with each move. But when the US applied a worldwide tariff on washers in 2018, That escape route closed and prices shot up, as we saw earlier. The lesson for companies was that tariffs on one country encourage country-hopping, shifting factories around like chess pieces. But broad tariffs force more drastic adjustments. We also saw many firms tariff engineering their products to get around duties. A famous anecdote. In 1983, the US slapped a 45% tariff on large Japanese motorcycles to protect Harley-Davidson. Japanese bike makers didn't flinch. They simply tweaked engine sizes from 700cc to 699cc to slip under the tariff threshold. The tariff ended up giving Harley little to no benefit because competitors cleverly evaded it. This kind of agility is common, whether it's slightly altering product specifications, rerouting shipments through third countries, or using bonded warehouses. Companies will find a way. Perhaps the biggest supply chain shake-up of late has been the Great China diversification. Once upon a time, made in China was almost a given for cheap manufacturing. But as US tariffs on Chinese goods hit more than $350 billion worth of imports by late 2019, companies responded by shifting production elsewhere. Vietnam, for instance, emerged as a winner. US imports from Vietnam surged as factories relocated there, or Vietnamese firms filled the gap for tariffed Chinese goods. By 2024, the US was running a $123 billion annual trade deficit with Vietnam, a huge jump, indicating just how much trade shifted away from China. Mexico and other Southeast Asian countries likewise saw US orders boom. Apple began producing certain iPhone models in India. Toy makers moved production to Indonesia or Mexico. Clothing retailers increased orders from Bangladesh. Yet investors should note this supply chain shuffle takes time and isn't seamless. A Federal Reserve analysis found that while United States imports from China dropped and imports from other countries rose, those other countries in turn imported more from China for the materials or components. In effect, some Chinese input just went in through the back door. By the end of 2023, China's direct share of United States goods imports had fallen from 22% in 2017 to about 14%. A significant decline, but the world's reliance on Chinese manufacturing didn't vanish overnight. The substitution elasticities are limited in the short run, meaning companies and consumers often had to swallow higher costs for a few years before new supply lines fully took hold. For investors, understanding these chain reactions is key. Opportunity can knock, for example, logistics firms and emerging market manufacturers benefiting from rerouted trade. But so can disruption, as companies face short-term inefficiencies. In portfolio terms, tariffs set off a grand resorting of winners and losers in the global supply network, and only the agile thrive. Trade deficit juggling shifting balances, little change overall. One of the political goals of tariffs is often to reduce trade deficits, particularly the US trade deficit with China, which has long been a sore spot. In theory, taxing imports should curb imports and thus shrink the deficit. In practice, the outcome has been more of a shell game. Bilateral deficits shift, but the overall trade gap often remains stubbornly high. Let's examine what happened during the recent US-China trade war. In 2018, before tariffs fully bit, the US goods trade deficit with China hit a record $419 billion. After rounds of tariffs and China's retaliations, imports from China did fall. By 2019, the deficit with China dropped to about $345 billion, roughly back to its 2016 level. On the surface, that looks like progress, but dig deeper and you find that American import demand didn't disappear, it just went elsewhere. As the US bought less from China, it bought more from Europe, Mexico, Taiwan, Vietnam and others, widening deficits with those trading partners. In fact, the overall US trade deficit barely budged and even grew to record highs in subsequent years due to macroeconomic factors like fiscal stimulus and strong consumption. Tariffs basically rearranged the who and where of the US import picture without dramatically altering the